Hi guys, Vipin here. We are here to discuss about insurance and we will discuss this topic in detail. Okay, now firstly let's start off by understanding what is insurance. Okay, now insurance is a contract between the insurer and the insured. Okay, insurance is a contract between the insurer and the insured. Now when you refer to insurer, okay, that refers to the company that's selling you the insurance policy. Could be LIC, could be Birla Sun Life, could be HDFC Standard Life, could be any of those companies that is selling you the insurance policy. Okay, now the insured is you and I. When we take up the policy, we are called as the insured. Now why would anyone go about taking up an insurance policy? You take up an insurance policy because you want to protect yourself or your family in case an eventuality were to occur. Now, what eventuality? That's not something I want to discuss, but in case something were to happen, an insurance company can compensate if this eventuality were to occur. Now, you have an offer and a consideration that goes about happening here. The offer is the insurance company will take care of you and your family if the eventuality were to occur. However, the consideration that you need to pay here is the premium. Each insurance policy has got its own premium. Depending upon the type of policy you have, the price or the value of the premium in fact varies. There are some policies wherein the premium is just a few hundred rupees per annum, while there are some insurance policies where the premium could run into lakhs together per annum. Okay, now firstly let's understand the principles of an insurance contract. Now first thing that you have there is the principle of utmost faith in goods. Now principle of utmost faith refers to the insurer and the insured must be clear on the terms and conditions within the contract. Now let's say I am taking up a health insurance and the insurance company is going to ask me questions like, does your family suffer from any heart problems? Because usually things like heart problems are in fact genetic in nature. Now if this were to be true, that is, if my family were to have a history of heart problems, I'm supposed to declare this in my insurance policy. Later on, if I were to get into some medical emergency and I have a heart problem, the insurance company may not compensate because I never mentioned these illnesses could come by any time in my life. At the same time, the insurance company as well should be clear upon the terms and conditions from their side. Now, when you refer to health insurance especially, the insurance company will make it very clear what exactly they are going to compensate. Okay, are they going to compensate you for the surgery, or are they going to compensate you for everything else that includes in the hospitalization bill? That is the medicine cost, the nursing charges, the consultation fee, all that are they going to take care of, or are they going to take care of only the surgical cost? So they need to be clear from their side and we need to be clear from our side as well. Okay. The next thing that you have is insurable interest. Now for example, if I were to take up an insurance policy now, okay, and let's say about 3-4 months down the line, I lose interest in that policy. However, the 3 months wherein I have actually paid the premium, I'm not going to get it back. Okay, I'm not going to get it back. The reason is when I took up the insurance policy, I had the interest to get the benefits of the policy. Later on, if I change my mind or circumstances were to change my interest or my opinion about that insurance policy, the company is not going to refund any part of my premium. So that's what you refer to as insurable interest. That is, when you take up the policy, you have the intention to get the benefits of the insurance contract. Okay? Now, indemnity. Indemnity refers to replacing something which has been lost. Of course, this is not possible with life insurance because for obvious reasons, you can't replace someone who's been dead. Okay? However, you could go about compensating them financially. In case of fire insurance, indemnity becomes quite common because you have a type of insurance policy where if the property has been damaged, the insurance company could replace the assets which have been damaged. Okay? Even in auto insurance as well, in vehicle insurance as well. If you have a windshield or a door which has been cracked or dented, you have the insurance company which will replace that with a new one. So indemnity here refers to something which has been lost and or damaged, and in this case it ends up getting replaced. Now, contribution. You can take up more than one insurance policy. Although I strongly advise against it, you do have the option and there is no authority that says you can't invest in this. Okay, I know a lot of people, in fact, when it comes to saving taxes, they invest in multiple insurance plans because they're able to get certain tax benefits. Now, although you want to invest in multiple insurance plans, the cost of investing in each of them purely depends on whether you are able to afford it or not. If you can't, then go ahead with just one policy. But like I said, there is no law that says that you can't go about taking more than one policy. In fact, I can take up a health insurance policy from many companies. In fact, let's say I find the policies of both Apollo and Religare very suitable to my requirements, where both of them are able to compensate me for certain illnesses. I can in fact take up both health insurance policies, but then again the cost consideration must be taken. Now, subrogation. Subrogation refers to, in some cases, especially in auto insurance, you come across situations where the insurance company is going to replace the part of the automobile which has been damaged. Now, let's say you got into a car accident, the door was dented. What the insurance company would do is they'll replace the door with a new one. Okay. Now, what's going to happen to the old door? The insurance company has compensated you by replacing the old door with a new one. What are they going to do with the old door is something which is up to them. Let's say they were to sell it for the scrap value. You will not be able to get any benefit from that, because your benefit ended after they replaced the old door with a new one. You cannot get any further benefit from the sale of that old door and the salvage value of that old door. The same thing you could say for even fire insurance. If some property has been damaged in a fire, and this property, however, has got some salvage value, the insurance company will keep that salvage value. They will compensate you by replacing what has been damaged. However, they will not give you any part of the compensation of the salvage value there. Okay, and then you have mitigation. Mitigation here refers to minimizing the risk from your side. Okay, minimizing the risk from your side. The insurance company expects you to minimize risk from your side. Say for example, if you take up a health insurance policy, it's not advised that you immediately take up smoking and drinking, because this is going to affect you in the long term, and this could in fact pose some serious health problems later on. So you should protect yourself from any problems that could happen. This could even mean if you're traveling in a two-wheeler, you're required to even wear a helmet when you are riding your bike. Even that is in fact a part of mitigation. Okay. Then causa proxima refers to the nearest possible cause. Insurance companies don't really look into the complete details of what may have happened. If it was a car accident, the policy would cover only a car accident. They don't really consider, okay, what is the real reason why it actually happened. Was it because they didn't see a pothole in the road, they suddenly lost control? That's something which they don't really look at. All they would look at is, okay, the nearest possible cause. If you refer to illnesses especially, if the illness is terminal, they would just categorize it as a terminal illness. They would really not get into the details of how did this person end up getting this and what he could have done in fact to avoid things like this. So causa proxima refers to the nearest possible cause. Now this question could in fact come for 10 marks, so please know that this topic in detail. Now, coming to the various types of insurance policies, they could ask you each of them for a 10-mark question. I'll try to be as brief as possible in this because I need to cover a large amount of information in a short amount of time, just to make the topic easier for you all. So firstly, life insurance, a whole life policy. In case of a whole life policy, the insurance plan, you will be able to get compensation upon the insured person's death. Okay, let's say in my case, if I happen to die at the mortality rate of 60, my family is able to get it as soon as I happen to die. So that's a case of a whole life policy. Endowment policy refers to a policy which has a particular number of years, and the eventuality should occur in that particular number of years. So that's what you would refer to as an endowment policy. Joint life policy is a type of insurance policy which is taken by two or more persons. Let's say a father would take a joint life policy for his wife and for his child. Okay, and then you have an annuity policy. The word annuity, if you're a mathematics student, annuity here refers to equal amounts of money being given back in equal intervals of time. There are many insurance policies which they also refer to as a money back policy or a cashback policy, wherein let's say you make the insurance policy, the investment today, around 5 years from now, and in intervals of 5 years, a certain amount of money is in fact returned back to your account. It's a form of savings for many people. So that's what you would refer to as an annuity policy. Term assurance. Term assurance is a type of insurance policy which is very, very similar to endowment, wherein if the eventuality occurs within a particular number of years, then you are able to get that compensation. If it occurs after that particular term, you don't get anything. Okay. Now, children's deferred insurance. This is an extremely popular type of insurance, mainly introduced by UTI. Now, how does it work? The parents should go about investing in an insurance policy right now, and the returns are given back to them when the child turns 18 or say 21, depending upon the policy they have. Now, this is a great way to save for the child's future, say for their college education or for their future, for their financial security, for any of that. If you want to save, this is one type of policy which is in fact extremely popular for that. Okay, and then you have policy with profits and policy without profits. Policy with profits are also referred to as unit linked insurance plans, wherein the premium that you would invest in an insurance company is in fact used to how do I say this? It's used to put money into the stock market. Your premium is in fact taken and is in fact invested in the stock market. Now this is done for a large period of time. I'm 26 now. If I were to invest in a ULIP, my premium every year would be in fact invested in the stock market. Now I would usually get these returns say when I'm 60 years old. Now from now to 60 years old, the stock market is going to move up and down continuously. In fact, it's a very volatile system. So what happens here is, let's say the stock market does extremely well when I was 40 years old. Okay. Now, how well it does when I'm 40, let's say I'm able to get a return of 20% when I'm 40. This high rate of return which I get in one particular year is what I'll be getting when I'm going to retire. Let's say at the age of 60, the market is doing quite badly, where I'm going to get only 8% rate of return. ULIPs work in such a way that in that period of investment, whichever period had the highest rate of return, that is something which they're going to give you back. This is one of the reasons why they're one of the most popular forms of investments. Policy without profits, like the name says, you don't get anything extra. You're not able to get any compensation out of the investment. It's just like any other regular insurance plan where you just save for the future. Okay. Policy with profits, you're able to get the benefit of the stock market. Okay. And then you have group insurance, extremely popular if you're in the corporate world. This is one of the very famous benefits which companies give to their employees. It's a way to keep them more motivated. Okay. And then you have Janta policy. These are the types of insurance policies where the value of the premium is in fact just a few hundred rupees, and of course the compensation as well is in the range of 1 lakh or 2 lakh rupees. The only advantage is it's able to protect the risk of the minorities. It's able to in fact make people aware of something like insurance and get the benefit of risk protection at a very, very low price. Like I said, the premium on this is just a few hundred rupees per annum in comparison to a regular life insurance premium, which could run to in fact tens of thousands per annum. Okay. Now, moving on from life insurance to fire insurance, specific policy. Fire insurance, before I get to the types, fire insurance is always taken for property. Now, in case property were to be damaged from a fire, you're going to get compensation from the insurance company because the goods have been damaged due to the fire. And remember, the compensation is given only if you made adequate arrangements in order to reduce the chances of a fire. In case the fire was intentional, as they call it as arson, you will not be getting any compensation in that case. So what are the different types of fire insurance policies? Firstly, you have specific policy wherein a specific asset is insured. This is very common in case of a museum where you have artifacts which are in fact extremely valuable. They would end up taking an insurance policy on each of these artifacts. Comprehensive policy covers a variety of risks. Okay, it covers a variety of risks. It could cover even life, in fact. That is, in case a person were to die from a fire, even that is covered in case of a comprehensive policy. Floating policy. Let's say you have a type of policy wherein you are going to consider the various properties that you have across the country. Okay, various properties that you have across the country. In that case, you are going to take up a fire insurance policy not just on one property, but you're going to take it up on multiple properties. You do that because you want to make sure that you get the benefit of insurance throughout the places where you're doing business. In that case, you end up taking a floating policy. Replacement or reinstatement policy. If you remember the concept of subrogation, I told you that property which has been damaged is in fact replaced by the insurance company. In this case, you have the property in fact being replaced because the fire has ended up damaging this. Of course, remember, this is not possible in case the property which has been damaged is unique or one of a kind. In that case, the only thing they could do is end up giving you a financial compensation and not really replace something which is in fact unique or one of a kind. Okay? And then you have valued policy. In a valued policy, the property is valued when the insurance policy is taken up itself. Now, right now, the home I'm currently staying has got a market value of around 60 lakhs. Okay. Now, that is of today, February 10th, 2014, it's worth 60 lakhs. Now, I'm sure the value of this property is going to increase over a course of time. Now, let's say a fire were to happen in this place after about, say, 5 years from now. Okay. In 2019, a fire is going to happen. If I've taken up a fire insurance policy today and the fire insurance happens and the fire happens 5 years from now, the insurance company will end up giving me only 60 lakhs because a valued policy is what is the value of the property as of that particular date. So even if the fire happens in 2019, when the property value is in fact quite high, I'll still end up getting the value of the property only as of 2014. Unvalued policy, the other way around. You are able to get the value of the insurance claim based on the present day market value, not on what is decided on a previous day. Then you have loss of profit policy. Now, a loss of profit policy is a type of policy wherein, now if you remember the Russell market fire, a lot of the traders in fact were unable to do business for several days. Now, why were they unable to do business for several days? Now, the reason was after the fire had happened, these guys had to get their business back together by replacing whatever has been damaged, removing the debris, putting up the new shelves, getting the inventory, all that. Now, this would have taken them at least a month. Now, an entire month they've been unable to do any business at all. Now, because they've not been able to do any business for an entire month, whatever are the profits that they could have made, that's what the insurance company would compensate them for. Now remember here, this is not like any, you're not making any jackpot win here. You could have been doing business normally if circumstances had not altered due to the fire. Now, rather than selling goods like you would do usually, you're getting compensation from the insurance company in a loss of profit policy. Okay. Now, moving on to marine insurance. In case of marine insurance, you have voyage policy. Marine insurance is in fact a type of insurance which is usually taken in case of foreign trade. So the first type of policy that you would have there is voyage policy. Voyage policy covers insurance based on a particular amount of distance. That is, how many nautical miles do you have to take in order for the policy to be valid. Let's say you have an insurance policy for say 100 nautical miles. Now, the ship is considered to travel 100 nautical miles. If it were to cross beyond that, any damages that were to occur beyond that distance that they travel, that's something which the insurance company would not compensate. This is very, very similar to the warranty that you have on your automobiles, wherein they say 20,000 kilometers or 30,000 kilometers, until then you have free service. And that's the similar way in which this insurance works as well. Time policy, the amount of days or the number of days it actually takes for the ship to reach its destination, and the insurance policy can be made valid for that number of days. Mixed policy, a combination of the two. Okay, valued policy and unvalued policy, exactly as what I said for fire insurance, no different here at all, but just that the same concept is implemented for marine insurance. Then you have wagering policy. Now, wagering policy here refers to a type of policy which is given just for the sake of satisfying the customs guys. What that means here is the customs will not allow you to send these goods out of the country if you are if you're not having any insurance with you. Insurance is mandatory. However, let's say you are unable to afford the insurance. You get more or less a policy which is a dummy policy. Okay, this is perfectly legal. You're just showing the customs guys that, look, I have a policy, but in reality, if any damages were to occur to your property which you're sending across for foreign trade, you will not be getting any compensation for this. Now, this is what you would refer to as a wagering policy or an honor policy. Okay, you are not going to get any compensation. Remember, you're getting a policy just for the sake of making sure the customs allow you to send these goods out of the country. Then you have a floating policy. A floating policy is a type of policy wherein one insurance policy is valid for multiple trips. Now, a ship would be traveling to and fro from to the same location multiple times. So, in order to avoid taking insurance policies continuously, you have one policy that's able to cover multiple journeys of the same ship, of course. Block policy is a type of policy wherein from the time you dispatch the goods from the manufacturing plant, you send it through, say, roadways, railways, until it reaches the port. Okay, and even after when it leaves the port and goes to its destination, the policy continues to be valid. So, your marine insurance, although the word marine is there, is in fact valid right from the manufacturing point itself. Okay, so that's what you refer to as a block policy. Now, there are other types of marine insurance as well, like you have one which is known as shipbuilders risk policy as well. Okay, and you even have a special hazards policy in case you have pirates and everyone attacking you. Shipbuilders policy, like the name says, any damages were to happen during the construction of a ship, the insurance company is able to compensate you for this. Okay, I hope the topic was clear, and I hope I didn't rush through this too fast. In case you have any doubts with any of the concepts here, you are welcome to go about leaving questions, comments in the section below, and I'll get back to you immediately. Thank you for your time. Have a nice day, and please don't forget to subscribe to my videos. Thank you.